I can start.
Yeah.
Start answering questions.
Yeah. Yeah. Just like we covered. Yeah.
See what kind of questions we get.
Yeah. It's your own, bro.
What do you, if you're investing, when you're buying bonds for portfolio, you said we bought a bond, but do you have a general idea of what the yield was?
Yes. 5.36% is what has been the average yield this year. But it's ranged from 550, 540-ish up to almost 6%.
Targeting the maturities between 5 and 6 years, or are you going out longer?
A little bit longer, staying the duration.
Absolutely. Okay, you need to start? Okay, I think we're going to go ahead and get started. I know, I feel so important. We're going to go ahead and get started. I want to welcome everybody to the Des Moines Teachers Annual Meeting. And thank you for coming out on this beautiful day and spending time here with us. We appreciate that. We have a small presentation to go through today. This is meant to be your meeting. So if you have questions at any point in time, please ask questions. This is meant for you to get answers to any questions or to give us things that you want us to work on throughout the year. So again, this is your meeting. And with that, I think we'll go ahead and get started. Coming. And if you can cue up the slides. There we go. There we go. All right. So today's agenda, we're just welcome any introductions. I'm Kathy McKay. I'm the Director of Employee Services. I have with me Ben Lupkeman, who is our Business Office Manager, and then representatives from BTC, Alan and Jeff, along with me. I also want to recognize the people out in the audience who serve on our committee. And I see, let's see, Brad Becker, who is a citizen rep. Lola Mann, Barb Mitchell, and Blake Hammond. those are the only ones that are currently in the audience. I want to go through our advisory committee. These are the members here listed on this who served in the advisory committee role last year. So Matt Smith as the associate superintendent, Brad Becker as a citizen rep, Melissa Spencer as a citizen rep. We also have one vacant seat as a citizen rep, and I believe we have someone interested in filling that. So that name, and she is here next to Brad, Lucy, and she's interested in filling that. So we will be submitting her name for the board to the board for approval. Blake Hammond is currently an active rep. Jessica Gogarty, an active rep. We have a vacant seat on our active side. And we have Barb Mitchell as a retired representative, Rich Bright, and Lola Mann also as retired representatives. These are the individuals who serve you as a plan member. So if you have questions at any point in time, these people are the individuals to contact and who can advocate for you and anything that you have for plan concerns. And with that, I'm going to turn it over to Ben for the financials. And Ben, take it away.
Hello, everyone. My name is Ben Luperkman. I'm with Business and Finance with Des Moines Public Schools. Hopefully, you've all seen the financial report for the year ended June 30th, 2023. The really best news, of course, is that the unrealized loss from a year ago substantially decreased. Last year, you remember, it was over $34 million, and this year is $4.3 million. I would reiterate that is unrealized. That is just fluctuations in the market. Everything else has been very consistent. Contributions, revenue, a very slight change. Everything is very consistent. Your plan members do continue to decline. And you will see that throughout the rest of the life of this plan. Members decreasing, as well as your assets will continue to decrease over time as people retire and draw funds from the plan. And really, I'm not sure if there are any questions, anything anybody specifically wanted me to cover.
Go back to the previous slide.
Oops.
We only got a real quick glimpse.
Yep. We're going to ask for that to be popped up.
Ben, you just want to walk through the slides.
Which one popped up?
The slide. I think, can you go back on the slide? The previous one, or is that the one?
No, the one
Oh.
This is
with all the numbers.
Okay.
Okay. The participants, the comparison, you'll see how active members have declined from last year to this year, as well as retirees and inactive members. Total membership has declined by 61 individuals. Here's the summary of all the changes of income coming in and expenses going out. Benefit payments, you see, looks like they decreased quite a bit, but in reality, what that was a decrease in lump sum payments from last year to this year. I think last year seen a very abnormal amount of lump sum payments as professionals exited the teaching education based on the unfortunate events of COVID. The net investment income, you can see, is very stable, actually increased about $300,000. Contributions, there it is. I was looking, I don't know where that slide came from. This one's for 23-22. Net investment income did decrease by 1.3 million. Contributions received stayed very steady. The benefit payments, that's the decrease I was speaking of. There's no really a lot of lump sum payments this year. And then the investment rate of return last year was actually negative. I would like to just point out that the investment rate of return as calculated by the actuaries, which takes into account the unrealized loss. And when we look at something like the calculation for excess earnings, we do not take unrealized loss or gains into account. It's only what's actually happened within the plan for the year. So that is, but it's still very beneficial moving from a negative 9.6 to 3.4. Plan assets, you'll see decrease 9.8 million. The funding ratio is steady with the prior year, as well as you can see it's right there, very similar to the funding ratios we have for, we don't have the 2023 numbers for IPERS yet, but we do have 21 and 22, just for your reference up there to see how IPERS is funded versus the DMTRS plan. And moving forward, we have continued collaboration between all plan stakeholders, comprehensive consideration of all practical opportunities to improve the plan. I know the representatives on your plan, as well as DMPS officials, specifically Mr. Matt Smith and other officials, work to make things a little bit better for the plan participants with some additional contributions starting this year. So hopefully that will help, and you'll see a little higher plan assets in the near-term future.
Are there any questions on the financials at all? Quiet group. Oh, yes.
If you want to come to the podium, there's a microphone. It might be easier to hear for the people that are listening online. Sorry to put you on the spot. Thank you.
I just wondered, I don't really know anything about that. So I was just wondering whether the contributions are for the active.
It is. It's for the active participants. It is done through payroll and funded by DMPS. It was not, the employee contribution did not increase. It was only
Okay.
employer contributions. But yes, it is only for active
And so that
members.
the idea is that would increase their payout, hopefully.
Yes, as well as plan assets, yes.
Okay, thank you.
I have a question about excess earnings.
Yes.
Yeah.
Yeah.
I noticed that all the groups got a little percentage increase in excess earnings except for Group E. Could you address that?
Yes. Group E, the excess calculation is based on a pro rata percent of the funds, the plan's liabilities. And because of the disproportionate share of Group 4, which is Group E participants, basically the denominator for that group remained unchanged. That's why the percent held steady. Because of the declining liabilities in the other groups, that's why you've seen smaller increases. The best example is Group 1. Group 1 went from is a 2% increase, but that's because the liabilities for that group decreased from one individual, from 2 to 1 individual. So liabilities went in half.
Okay.
Does that make
Yeah,
sense?
there's a lot bigger group than in Group E.
Yes.
Okay, thank you.
Any other questions regarding the financials? Okay, with that, I will turn it over to Alan and Jeff on the BTC review.
Okay, thanks, Kathy. If you could advance it one slide, there we go. We'll start out with governance, and just as a reminder, the plan investments are managed according to the guidelines specified in the investment policy statement, or IPS for short. And the Des Moines School Board, just as a reminder, they approve all of the guidelines that are in that policy statement. And I know from time to time they approve changes, and many of you who have been in these conversations for several years are familiar with changes we've made in the process through which those changes were approved. So just a reminder of how the rules get established and maintained. As of September 30th, not too long ago, portfolio value and asset allocation, first of all, the portfolio value was 170.8 million. It's still in that area today, but it moves up and down. Can move up and down 250,000 to 500,000 a day based on what the equity market is doing, because there's an allocation to equities. And it also moves up and down based on what the fixed income markets are doing, based on the movement in interest rates. So as of September 30th, 170 million in market value, but it does move up and down a little bit. The portfolio is comprised 76% of fixed income or bonds and money market, which is where cash is placed. And incidentally, the money market rate as of today is about 5.3%. And I know there have been lots of questions over time about what are the interest rates we're getting? Yeah, Blake. Yeah, thank you, Blake, for all those questions. Those are the right questions, by the way. We appreciate the engagement by everybody on these in the discussions about the policy and in the discussions about the assets and how they're being managed. But one of the key things is the money market rate on excess cash is about 5.3% currently, and we do hope that no predictions, but we do hope that it stays steady around 5%. We'll see what the markets do, but that's a big positive change for the portfolio over the last 18 months. The other portion of the allocation, approximately 24% of it, is equities or stocks. This is specifically individual stocks, and it's primarily U.S. large cap stocks. And even within that category, it's primarily value stocks versus growth stocks. And one of the key characteristics of value stocks is they pay higher than average dividend yields. So the dividend yield on this portfolio is about 3%. And so just like bonds that pay interest, these stocks, they're paying a dividend of about 3%, and that's very good. The average on the S&P 500 is around 2%. So the allocation to U.S. equities represents a tilt, as we would say, toward higher dividend paying stocks in the interest of supporting the earnings of the plan and the distributions that are made every year. More specifically, let's talk about fixed income in the bottom third of the page and the composition of the fixed income portfolio as of June 30th. And really, this doesn't fluctuate a lot, so it doesn't really make a difference whether or not we're talking about June 30th or today or past month ends. The allocation is approximately 60% corporate bonds most of the time. It's not going to fluctuate much. That's the target allocation, and it happens to be the allocation as of September 30th. The remaining is 23% in taxable municipal bonds, and then 13% in mortgage-backed bonds. There are other smaller pieces or allocations in this fixed income allocation, but these are the three largest subcategories within the fixed income group. The average quality is it's single A1, which is very high quality, about in the middle of the investment grade spectrum. The average maturity is 9.2 years. And the current yield is 4.9%. And slowly rising, fair to say,
Yeah.
Jeff?
Yes.
Slowly rising.
Higher
as bonds mature and they're replaced by higher yielding bonds. Interest rates have been going up for the last 18 months. And so every time we replace a bond, we're replacing it with a higher yielding bond than what matured. So that'll continue as long as rates continue to go up. So we'll see how long rates go up. No predictions, sorry. And then finally, on the next slide, we'll just talk a little bit about the equity allocation. Again, this is 24% of the overall allocation. And within it, it's over 70% US large cap dividend paying stocks, which I touched on briefly earlier. But we also have real estate investment trusts, which are publicly traded real estate investments, very diversified, very large pools of assets, very diversified. The key there is that they have dividend yields in excess of 3%. So again, we're emphasizing the generation of income, not only in the fixed income portion of the allocation, but also in the equity allocation. There's a small allocation to small cap stocks, which are more growth oriented in nature and have lower dividends than the dividend would be 1.5%, 1.5 to 1%. So income is not the focus there, but it's a very small portion of the allocation. Overall, the equity allocation has a dividend yield of about 3%. It's a little higher. It's 3.02, 3.03, and it fluctuates a bit. But we're working to target a 3% yield, and we'll take it if it's higher. But we want to maintain it in the neighborhood of 3% and not really dip below that. Any questions? Any thoughts? Yes.
It seems like the division of the percentage, the 76-24, we've been about at that same level for several years. And I'm just wondering, is there any thought about, I know the percentages have to be within a certain range. Are you comfortable in more stock and fewer bonds? Or are you feeling like this is the best strategy moving forward? It's a conservative strategy, and not that I don't like it. I'm just wondering what your thoughts are.
The couple of points, and I want to see if I want to make sure that I explain this in an appropriate order. So the overall allocation, what are the key drivers of why you choose one allocation over another? How do you determine the allocation to start with? Why is it 76-24? Let's call it 75-25. Why is it that versus 80-20 or 90-10? And it did used to be 90-10, not in the 5 pre-COVID. It was 90-10. I don't remember 5 or 6 years ago it was 90-10. So why did we increase it? Why was it that way in the first place? Well, the classic way to determine what an allocation should be for an individual investor or a plan like this is to determine, well, first of all, what are your investment goals? How much of it's income oriented? How much of it's growth oriented? What's the total return that you desire or need to fulfill the goals of the plan? That's number one. But then number two, what is the ability of the plan and the participants to take risk? And that's defining risk can be a very difficult exercise. It's not concrete. But the primary driver of risk in this plan is the life expectancy of the participants. So how long will all of the participants live? And the actuaries, Brad is very well versed in this and has commented on this a great deal in the past. Thank you, Brad, for all of that wisdom. The life expectancy drives a large part of the risk in the portfolio, or what the risk in the portfolio should be. How much risk can we take? So we want to make sure that the portfolio lasts through the duration of the last participant. We want to make sure there's money there throughout the entire life of the last participant. You don't want it to run out. And we saw, and that's an exercise that's ongoing all the time. And we saw what the funding level was on a prior slide. And so we want to work to maintain the funding level and improve it at all times. So what that means is, sure, we want growth in the portfolio, which is driven by equities. But the more equities you put in the portfolio, the more risk that you introduce into the portfolio. Because equities go up and down much more significantly than fixed income. Fixed income is typically classified as preservation. Its purpose can be classified as not only income, but also preservation of capital. And for the most part, when you put money in a bond, you get that money back at maturity. Bonds can default, but fortunately, it's very rare, not only in this plan, but also just in the general bond markets. So sorry, a long answer to your short question, but whether or not we can take more risk, I know that's an ongoing conversation that we have with the committee. There have been discussions and thoughts about maybe increasing it from the current maximum allowed level of 30% to maybe 40%. Maybe 35 is an intermediate step on the way to 40. Whether or not that's needed is largely driven by the funding status. Is it fully funded or not? That funding status goes up and down with the markets, as well as the actuarial estimates of what the potential liabilities, I don't know if liabilities is the correct word, but what the potential payouts might be in the future. And so maybe in the future, as a committee, bottom line is, I think it's good to continue to have conversations about whether or not there's a need for more equity. And one of the key factors is in determining whether or not there's a need for more equity is, will it support the funding status if we add more equity, or could it potentially make the funding status worse if the equity market goes down and stays down? So I know that's not a concrete answer to your question, but it's more of it's a work in progress until the last dollar is paid out of the fund.
It's the big picture for me, which helps. Thank you.
Any other questions?
On one of the last slides, did it say, because normally, I think we've been 100% funded. But did that say how much we were funded?
88%?
88, that's what I thought it said.
Yes.
So that, of course, would be a consideration, right?
That would definitely be a consideration. So again, that's going to change with the markets moving up and down. And part of that is due to the fact that not only did the fixed income market decline, so that what you saw was as of June 30th. So it's going to have 6 months of 2023 and 6 months of 2022. And the most interesting part of that, at least to me, is in 2022, the fixed income market declined about 10%, and the equity market declined about 20%. And so on the rough math, 75% of the weight declined 10%, 25% of the weight declined 20%. So that's a decline of about 12%.
Yeah.
So guess what? 100% minus 12% is 88%.
Right.
So if the markets revert back to levels that were achieved not too long ago, no predictions, but the markets tend to recover and move forward and beyond previous all-time highs. If they do that, then likely to see a corresponding improvement in that funding rate.
Right. Okay, thank you.
How would the plan survive that very large drop in 2022?
How did it survive the drop?
Yeah, it's 38,000. Basically. Or maybe I'm misunderstanding what was presented.
You want me to?
Sorry, there it goes.
That was just for the counting and the financial statements. The loss, that very large loss, was unrealized. Just means that what was the
I can add to that if you want. So this is a common question we get in investment portfolios. Last year was an unusual year. Fixed income can go down, but really does it go down that much? So the key thing to keep in mind is when if you're a holder of bonds and the interest rates go up and correspondingly the market value of the bonds you're holding goes down, you only realize that loss or lock it in if you sell the bond. And for the most part, Jeff and the team, they hold the bonds to maturity. Rarely do they sell bonds, and so rarely do we lock in unrealized losses. So we rode the market down. We believed in the bonds that we had purchased, and we rode the market back up, and we're coming back up out of that dip.
That's very clear.
It is. That's something that it definitely catches my eye, and I kind of wondered if it, frankly, a little bit. I want to make sure everybody's concerns are addressed if you do have concerns, because the markets go up and the markets go down, and I want people to have, keep the mindset in the middle if you can, because it's an up and down process.
Thank you. All right, now to the fun part of the meeting. We have the advisory committee that I mentioned at the beginning of the meeting, and we have some vacancies. It's time for the elections, the annual elections. The terms for the advisory committee are a 3-year term, and we have 3 citizen reps, 3 active reps, and 3 retired representatives. The 3 citizen rep positions are recommended by the DMTRS administration to go to the board for approval. There is not voting on the citizen rep positions. The 3 active member positions, there is 1 that is up this year and is ready for someone to step into that position. We did send out a letter and asked for nominations for people who were willing to serve on that term. We did not receive any names of people who had put their names in to be nominated. However, we still will continue with voting. There was a QR code sent out, as well as a website that people can do a write-in. Whoever gets the most write-in votes, we will contact that individual and make sure that they are interested in serving, and then bring that name to the board for approval. And then the retired representatives, there are currently 3 representatives. Barb Mitchell's term is expiring this year, and she has graciously volunteered to serve again if elected. And so please, as a retired member, go in and do the voting for those positions. And I'm going to put on the screen right now, there's a QR code. There's also a website. For those of you that aren't familiar with QR codes, you can scan that using your phone, and it will take you directly to the ballot to do your voting. If you are uncomfortable using that QR code, you can also contact Sherry Weatherly in our office, and she can walk you through the process and do the voting for you, so you do not have to use that QR code or the website. But it's a pretty simple process. If you have any questions, please reach out to us. And with that, that concludes our meeting, unless anyone has any further questions. All right, thank you very much.
Thank you.
I'm going to leave that
Thanks, Jeff.
QR code up for just a little bit so people can.